I plan to touch a little bit on, not very much on last year's presentation, but just for those who maybe didn't see it, I want to give you some of the takeaways. A little bit about me. If I can get this to work, just a moment. Here we go. Okay. Alyssa already gave this introduction. The only thing I'd add is I am part of the Staff Employee Association. So if you have feedback or questions or comments or anything to do with you at Utah State, I can bring that back to that committee. But particularly, I'm on the benefits committee. So if you have suggestions or feedback in that area, that would be great. My email is there. I'm going to mention this, the QR code in the bottom. I have a bunch of links in my slides that that if you want to access some of those links, you can just bring out your phone, scan that QR code, and that'll get you access to the slides. I'll put that QR code up occasionally where there are links. I try to do that so that you can, if you're interested later on, you can pull that up. Oh, and the disclaimer was just that really you're going to need to personalize whatever I teach today. Take it to a financial advisor, and then this screen um, kind of helps because I often thought, well, I don't have a financial advisor, or I don't want to pay for one. So just know that if you work, many retirement plans offer free advising through if you have funds in those plans. And for Utah State University, if you have funds in a retirement plan, whatever company you have funds in, you have access to free financial advising there. And then you also last year you started a contract with Hub International, where employees can also have financial advising through Hub International, which is independent from the retirement plans, but they have access to help you work through those retirement plans. And I have met with several of these advisors. They're great people, and they think they're here to help us. They, from what I've been told, they don't get commissions off of anything, so they're not trying to sell us products. Um, and then here's just a few additional resources if you haven't already, and you're interested in being aware of what's happening with benefits. You can sign up for email or text notifications here. And then there's a few links here to some webinars if you want to learn more about this or similar topics. And at the very bottom, I've put a link to an HSA guidebook that gives a lot of really helpful information. It's really well written, giving good examples. So if you want to if you want to learn more about HSAs, about things I don't get to today, or even perhaps clarify things that I trip up on today, HSA guidebook is a really good resource. Okay, so a brief overview of last year's presentation. Last year's presentation was more focused on comparing health plans, and particularly on the high deductible health plan. I did use my experience to kind of show some of the numbers on whether or not I saved money being on a high deductible health plan. And so some takeaways from that is, going on the second bullet point, I was actually surprised to see, even in years where I had a lot of expenses, medical expenses, the high deductible health plan in my scenario actually ended up being cheaper than white or blue plans. And part of and going up to the first point on that, really to truly compare the plans, one of the simplest things you can do to get a really basic understanding of to compare plans is to add the premiums, the annual premiums, to your annual deductible. Because if you're not adding premiums to the calculation, you're missing a big portion of your medical expenses. And then I did mention in that presentation some tips for transitioning from a traditional health plan where insurance covers things earlier on, to a high deductible health plan where you have to cover things up front a little bit more. So particularly financially, but also other transition tips. So that's a great resource if you're just getting started with an HSA. And here are some numbers. I used this last year in my presentation. This is where you can see uh, my actuals are that first bar. And in 2015 to 2016, I actually switched to the blue plan because I knew we were going to have a baby, and I was like, maybe that'll be cheaper. And you can see the actuals actually ended up being higher than if I had stayed on the high deductible health plan. And that pattern really did follow through in all the other years. Even when we've had children born, it would have been cheaper on the high deductible health plan. When we had broken bones, it would have been cheaper on the high deductible health plan. So um, a lot of people think high deductible health plan means I'm going to be spending more money if I have an emergency or a big expense, and that may not be the case. So again, just something to consider. And there are times, depending on your situation, where that may not be true. So just if you use the calculator that I had in the last year's presentation, that'll help you kind of analyze what your expenses might be. Okay, so on this chart, the bottom section in green, that's the savings over time in based on the whatever plan I was actually on compared to the white plan at Utah State. So you can actually see in 2015 when I was on the blue plan, I actually paid more to have that plan than I would have paid to be on the white plan. But then all the other years I was on a high deductible health plan, and that bottom section is just the savings pretty much in premiums, but also medical costs for being on the high deductible health plan. And this top blue section is the tax savings, typically from contributing to an HSA, which is the exciting part that we're going to get to today. All right. Any questions so far? You can see in 8 years of being on a high deductible health plan and contributing to an HSA, I've saved about $14,000, which is not bad for 8 years. And that's not including any potential growth that might have occurred in the HSA. Okay, as a reminder, and you guys here too, sorry I'm kind of talking formally, but I do want this to be a conversation. I want to get your guys' inputs, your questions, so feel free to stop me as we go. So this year, I do want to continue the conversation, go beyond comparing health plans and focus more on how to utilize a health savings account or an HSA to take advantage of the benefits that it offers. But let's get started with, I'm going to launch a poll here. And just to clarify it, so the first and third questions are single choice, and the second choice, you can actually select interested in to learn today. So I'm launching that right now. And you guys in person, I guess if you want to answer that, that's fine too. So I guess what is our experience level with HSAs? Do you guys have HSAs already? Okay. Some yes, some no. Okay. Familiar with HSAs? A little bit. Okay. That's good to know. Awesome. We're getting some answers here. Probably close it in about 10 seconds. I'll end the poll in about 10 seconds. So. All right, and I'll go ahead and for those on Zoom, I'll go ahead and share those results for a moment, just so you can see the audience we're working with. So this kind of helps me understand where I should focus some of my time. I do want to get to some of the more advanced stuff, but I do also realize we've got some newbies here. that we'll want to explain some of the basics too. So let's go ahead and jump on in. All right, so here are some of the goals. I want you guys to leave better informed about HSA benefits and how you can use HSAs to your advantage, more empowered to grow your HSA, as well as hopefully some of the things I share are new ideas for those who are experienced and have used an HSA for a while. New ideas for contributing, growing, withdrawing funds from your HSA. Oops, I was early on the poll, so let's do a quick introduction to health savings accounts. The overall purpose, it was designed to allow those who have high deductible health a tax advantaged way to save for medical expenses, where it is kind of hard to find money to pay for expenses when you weren't expecting them. And so the government gave some tax advantages to be able to do that. And so you do have to be on a qualified high deductible health plan to contribute to an HSA. And here's a comparison. So a lot of people are familiar with FSAs. And one problem that I find is when I talk about HSAs, a lot of people confuse it with FSAs. So I've put up here a comparison side by side. In green, I've highlighted what I consider to be the benefit of one plan or the other. As you can see, there's a lot of benefits. If you have the option to contribute to an HSA and an FSA, you probably want to do the HSA. There's a lot more control and flexibility with this. I'm going to point out the top one, FSAs, flexible spending accounts. They are used, you have a year to use them, and there's not a lot of flexibility, and it's use it or lose it. And that, whereas HSAs, health savings account, is yours till the day you die, and then after that, you can actually pass it on to your beneficiaries. So it really is a savings account versus the flexible spending account. All right, here are some benefits of choosing an HSA, sorry. You have savings now. So you're saving by being on a high deductible health plan, you're saving in premiums. You also have tax savings for contributing to an HSA because now you're lowering your tax bill. And then when you use an HSA to pay for medical expenses, you don't have to pay taxes on those withdrawals. So it's one of the few accounts where you can actually put money in, grow it, and take it out without ever having to pay taxes as long as it's used for qualified medical expenses. Very similar to what an FSA, the advantages of an FSA. However, again, you get to keep this for longer, and there's a lot more flexibility with it. With an HSA, you can save for the future. You don't have to just save for near-term medical expenses. Funds roll over year after year, so you can max out this year, and it could pay for medical expenses over the next 5 or 6 years. You keep the money if you leave Utah State or whatever employer you have. And we've mentioned this, no deadline. And you do have investment options often in an HSA. And tax-free growth, which essentially it's kind of like a traditional or a Roth IRA. Those both have tax-free growth where you're not paying taxes every year that it grows. That's what that means. And the last one here that's important to consider is that I think a lot of us don't realize, or we don't think about how much medical expenses we're going to have in retirement. But according to a Fidelity study, it's about $300,000 on average for a couple is what you might expect for medical expenses in retirement. So that seems like a big number, and it is, but I guess it just shows like you can contribute to an HSA probably more than you think you're going to need because you'll end up being able to use it in retirement. Yeah, question. So the question is about passing on an HSA to beneficiaries. So if you pass it on to a spouse, they get to keep it as an HSA. If it goes to anyone else, it gets taxed that year. So the only thing they can deduct from that is, as a beneficiary, is if they paid any of your medical expenses before you had died. So if it was a child that maybe was paying your medical bills, they could subtract that from what gets taxed, but you don't get the benefit. It becomes a non-HSA as soon as it goes to a non-spouse beneficiary. So hopefully that satisfies that question. Thanks for the questions. These are, in addition to the financial benefits of an HSA, these are some of the things that I really like about HSAs. I have ownership over it. It's my account. I get to choose how I use it when I use it. There's flexibility. I can decide to contribute $1,000 this month and $0 the next month. You're not tied to a plan year where you have to set that in stone. Anyways, so a lot of flexibility, and then portability as well. The HSA funds aren't necessarily stuck with whatever employer you're in, even while you're employed. So I'm not going to go through all of these, but I wanted to have them available on the slides. There's a lot of myths about HSAs that kind of stop people from starting one or using one. And hopefully, as you read the answers here, this will alleviate some of that. So again, the big one, people think if you don't use it, you'll lose it. And that's false with HSAs. If you don't use it there's no deadline, I guess, to reimburse yourself. So you can reimburse it 10 years later if you want. There's no time limit there. And then here's this top one. I wanted to address this too. I must be on an HSA or on a high deductible health plan to use HSA funds. And the trick word here is use. You have to be on a high deductible health plan to contribute to an HSA, but you can use those funds anytime after you've opened your HSA. So for example, the year that I switched to Blue, I had built up my HSA savings, and I was able to use my HSA to pay for the baby that was born while we were on the Blue plan, to pay for the medical expenses. You can't use it for medical premiums, but I was able to use it for those medical expenses. And also this last one, HSAs are for medical expenses only. I'm going to get to that, I think, pretty soon, but that's kind of true and false. It's designed for medical expenses, but once you get to retirement, you can actually use it similar to an IRA. Here's a couple did you know things to consider. One thing that I didn't know till recently is you can reimburse mileage. It's not a lot. It's like 14 cents a mile or 17 cents a mile, but going to and from the doctor or the pharmacist or whatever, you can actually reimburse for mileage. So, and then you can invest HSA funds. That's something that some people don't realize, is that that's an option. Yes. Yeah, so the question is, how do I know, essentially, can I find a list that tells me what's eligible and what isn't? The answer is yes, and I'm sorry, I didn't include that. I don't think I included one on here, but if you search the internet for, what was that? I don't know, HR might have it on their website, but if you do a quick Google search for, is such and such HSA eligible, you'll quickly find one of these lists or one of these websites that have a whole big list that you can then search for other things as well. So great question. So we've talked about some of the benefits of an HSA and how HSAs can be used. And before I go on to some of our strategies, I'm going to introduce a foundational concept that's going to that can help us rethink how we might use an HSA going forward. So the foundational concept is that you can use HSA funds after you turn 65 for any reason without penalty. You do have to pay taxes if they're not for qualified medical expenses. But what this rule allows you to do is you could essentially be contributing to an HSA as if it were a retirement account, um, and withdraw those tax-free for anything that's non-medical. But you have an added benefit of anytime you do have medical expenses, you can actually pull those out tax-free. So it's kind of like a traditional IRA, but with a separate contribution limit and the flexibility and the ability to take advantage of withdrawing medical expenses tax-free. So that's a foundational concept I'm going to introduce, and the reason I need to introduce it is that now you can think of an HSA not just for medical, but as part of your retirement strategy, or at least have that as an open option, knowing that I can take advantage of tax benefits now, and it also widens the opportunity to have tax-free withdrawals depending on whatever my medical expenses are, and the flexibility to use it for something else if I end up contributing too much. Do we have any more questions in person, online? Yeah.
Contributions are tax-free. You said they're variable. So do you get the tax credit on the back end when you file your annual taxes? Or does it come out before you get taxed each month?
Okay, yeah, so the question is on contributions, if they are, how they're taxed, or how you get the tax benefit. So the way it works is if you're doing it through an employer plan, through payroll deduction, they do all the work to say you don't have to, they essentially decrease your taxable income that shows up on your W-2. So you don't have, the only thing you have to do is report the box 12, I think it is, it says how much was put into an HSA for you. So that takes care of it automatically. If you contribute to an HSA outside of that, the tax advantage comes when you file your taxes. Does that answer your question? Was I missing anything? Okay, great question. And I've mentioned this a little bit, but the triple tax advantage of an HSA, this is something the traditional IRA doesn't have all three of these. Roth IRA doesn't have all three of these. You're getting taxed somewhere with either of those accounts. But with an HSA, again, assuming it's for qualified medical, you don't pay taxes. And if you search the internet, you can find triple tax advantage, but I actually like to call it quadruple tax advantaged, because unlike retirement contributions, your HSA contributions, again, if it's through payroll, you actually don't pay FICA taxes or your Social Security and Medicare. So that's just something to keep in mind. That's 7.65% right off the bat, even if you're in a 0% tax bracket. So kind of cool. And then here's just comparing the traditional, which is pre-tax contributions, versus an HSA, and versus a Roth, which is you get taxed when you put it in, but you don't get taxed when you take it out. So you can see the HSA really outshines all of them. The only time that it doesn't have all the benefits is if you're withdrawing for non-qualified expenses, but even then it's no worse than a traditional IRA. In fact, it's better because you can have that FICA tax advantage that you don't get with the traditional IRA. Any questions? Okay. All right, so now we've laid a foundation. We've talked about how an HSA, how some of the benefits of an HSA, as well as kind of the idea or the concept that you can use it more than just for health expenses. And now let's get into some strategies. First of all, the number one way, I'll occasionally mention ways to grow your HSA, and the number one way is to contribute. You can't grow your HSA without funds being there. So that's the number one thing. If you want to grow a health savings account, you need to contribute. And here are some strategies. I put this as beginner strategies because this is kind of the minimum I would recommend people do. Um, this first one, minimally funded HSA, I wouldn't recommend this unless you just happen to be on a really tight budget and you cannot do more. But essentially, you're trying to treat an HSA like an FSA, and you don't want to contribute too much. But if you understand that you can use it in future years, um, and you have the budget to do so, I would definitely contribute more. And that's where this second one, the premium difference, this is what I would say you want to at least shoot for doing this. And what this is you take your health plan options. If you have a high deductible health plan and a traditional health plan, you figure out what's the difference in premiums and put at least that amount in. So essentially it makes it so that your what your what's coming out of your paycheck for medical is the same as if you were on a traditional, but the benefit is, again, you get all the HSA benefits, which is that money's yours. You didn't send it to the insurance company. You put it in your own pocket in an HSA. So, and then this next strategy, I'll call it a milestone because it might be your strategy initially as you're getting started, but really it should be a milestone. You want to get your HSA as soon as you can to where it would equal the amount of your high deductible health plans um, deductible, and then the next milestone would be getting to the out-of-pocket max for a year. And then if you use as you use those HSA funds, go ahead and replenish it. All right, and then here are some additional strategies. I'm going to briefly go over the HSA for health only. This is, you realize that you will have medical expenses in the future, whether it's next couple of years or you realize it's going to be in retirement. But if you are a person that really likes to have strict boundaries on this account is for this and this accounts for this, this might be where you end up after the presentation today, where you say, okay, I'm convinced I'll contribute more to an HSA because I know I'm going to need to use it. But I don't know if I feel good switching where I'm putting my retirement funds from a traditional or a Roth to an HSA. So that's a strategy. The tax optimizer gets you to the next level where you realize that the HSA can be a part of your retirement fund planning. And so even though you might have only put $200 a month in it for actual medical expenses, you decide I'm going to put the other however much I can to max out that account so that I can take advantage of all the tax um, the tax benefits of an HSA. Any questions? Okay. Thinking, does anyone not like this? Any concerns or yeah?
I can't remember. Can you only contribute until age 65? You can't contribute after that, I think.
That is a good question. The question is, can you contribute only to age 65? I don't remember if there's a limit on the age. I think it's more, if I'm not mistaken, I think it's more about if you're on a qualified high deductible health plan. And I'll get to one of the caveats as you're getting close to that age, something that might affect it in a little bit. Okay, I'm not going to go through this, but if for those who like to know, so what would you recommend as a proposed order of operations of which account to max out first? This is a guide. You don't have to follow it exactly, especially numbers 3 and 4. It really depends on a lot of factors. But you want to take advantage of any employer match you get because usually that's a high rate of return that you're getting. But then HSA, again, HSA's got more benefits than you can find in any of the other retirement accounts. So if you're fine blurring the lines to do the tax optimizing strategy, HSA would be next. And at Utah State, we don't get employer matching. They put funds in without needing to match, and so you can go straight to the HSA if you're at Utah State and you want to focus on optimizing your taxes. And the HSA, again, if you do it through payroll, you can take advantage of that FICA tax savings. So, which you wouldn't get if you contribute outside of payroll.
Found the answer to my question.
Okay.
As soon as you go on Medicare, you can't. So if you don't go on Medicare, then you can keep doing it.
Okay, good to know. So if you're 67 and you're not on Medicare yet, and you are on a qualifying plan, you could contribute. You could continue to contribute. Good to know. Thanks. I'm not, again, QR codes there. If you want to learn more about these strategies or these unique scenarios, take a picture, snapshot of that QR code and click those links on this slide. These are some tips if you want to give your HSA a kickstart or a jump start. Things that you can look at. Another unique scenario is for those who maybe have a child that's still under 26, so they're on your high deductible health plan, but say they get married and so now you can't claim them as a dependent on your taxes. Because they're on a family high deductible health plan, you can actually, or they can contribute. Really, anyone can put funds into an HSA for them, but they can get the tax benefits of an HSA and to the full family contribution limit, which is kind of cool. As I was preparing this, I was thinking of a scenario of, your kid's getting married, and it's a wedding gift, and if you're wanting grandbabies, that might help financially alleviate some of the concerns with having a baby too. So there could be some benefits. But don't use that as pressure. You can't give them money and then say you must have grandbabies for me. Yes. Yeah, thanks. And sorry I didn't put that on the slides. For 2022, the family contribution limit is 7,300, and that's for family coverage. For single coverage, it's half that, or around half that. And then if you're switching between a traditional plan like the white or blue plan at Utah State to a high deductible, you would need to prorate that unless you're taking advantage of, say, the last month rule, and you'd want to read up on that to determine if that's something you want to do. So great questions. Okay, here are a couple gotchas, and this is where what you had mentioned about going on Medicare. I don't know why, but it's actually, you have to stop contributing or you become ineligible 6 months before you go on Medicare. It's the weirdest thing, but that is something you'll want to watch out for as you approach that age and getting ready to sign up for Medicare. If you have a spouse that has an FSA, that actually disqualifies you because technically you're covered by something that's a medical plan that's not a high deductible, qualified high deductible health plan. The high deductible health plan does have to meet certain regulations. So if you don't know if yours does, contact your HR, or if it's through the marketplace, contact that insurance provider to make sure that you are eligible for that. And this last gotcha here, if you do want to do the tax optimizer strategy, just make sure you have some boundaries so that if you have big medical expenses, you're not pleading your retirement savings because you put it all in an HSA. So, and that's where I'd say if you're going that route, max out as much as you can budget for, and realize that some of that you may be taking out for medical expenses, and that won't be part of your retirement funds. And we've got a question online.
Okay. If your spouse has a preferred plan, but you have a high deductible plan, can you contribute to HSA?
So if your spouse has a traditional or non-high deductible plan, and you have a high deductible plan, what was the question? Can you contribute to an HSA?
Yeah.
Okay. It depends. If you are covered on your wife's traditional plan, no. But if she has self-only coverage and you have then yes, you could contribute as long as, again, she doesn't sign up for an FSA. As soon as she signs up for an FSA thinking, oh, this will just be for me, per IRS guidelines, you automatically are included as a potential beneficiary of that and it disqualifies you. So, but if it's just strictly medical plan and it's self-only coverage, you could. Sorry, I'm making sure we're doing okay on time. So growth strategies, I did see some people were interested in this. It's going to be a really short section because some of the growth is going to come from the next section, but I do want to touch on a few things. For the longest time, I just had all my funds in a cash account with the HSA. But again, you can invest if your bank, your HSA account has investment options. And if it doesn't, and USU's does, they do if you're going through WEX. But if you went through a different bank and they don't have options, again, you have so much flexibility and portability with these HSA plans that you can roll it over or transfer it to another provider, which is okay. Yeah. I'll get to that transferring in a little bit, but number way to grow your HSA is to invest it. Sitting in cash, it's not going to grow very much with today's interest rates. So, all right. So here are some things when you get started with investing, just some things to be aware of. A lot of HSA providers do have a minimum balance that you need to keep in cash. Usually it's because they want you to have something should you have a medical expense that you can withdraw without having to cash out investments. So they're trying to protect you, I think the idea behind it. Some also have limited investment options. It might be limited to like 20 options. And then you'll want to watch out for any fees. So if you invest most of your money and then it drops and now you're below some type of account limit, you could be paying monthly fees because you're below that. So I saw you have a question. No, okay. Looked like you were about to. So, all right. So what if you have an HSA that does investment options, or perhaps it does, but they're very limited? How do I expand my options? So the first thing I'll say is check if that bank has a brokerage account option. And this is something, if I remember right, I don't think Health Equity had this when we were with them, but WEX does have a brokerage option. So if you don't like the options that are by default in WEX, you can set up your investments to go to a brokerage account. I think it's with Charles Schwab, and it opens up a whole lot of investment options. So that's something to consider. Another option is, again, if you don't have a brokerage and you really want to invest elsewhere, you can open up an HSA separate from your employer, and you can either contribute directly there. If you do, though, you'll lose that FICA savings, but that'd be something you'd think about. Or another option is you can actually transfer funds to your personal HSA provider, even while employed. So this is when we were with Health Equity, I wanted additional investment options. So I actually did start to do this. If I were starting now at WEX, I probably would have just used WEX's brokerage just to keep things simple, because they can automate some of the transfers and stuff like that. Whereas doing a partial transfer or transferring funds from the employer account to a personal HSA, it's a manual process. I have to submit a new form, fill it out, and submit a new form every time I want to do that, which can be tedious if I'm contributing through the employer and transferring funds. So I guess another potential benefit of having a second HSA is you could distinguish there if you want to have that boundary line of this one's for medical expenses and this one's for my building retirement. That'd be an option. You could do that. Any questions on growth strategies? Okay. So let's get into distributions. Yes.
I guess accountants who, for growth strategies, they actually tell their clients to put in the full amount that you can, the 7,300, and then any medical bill that you have, pay out of pocket. Just keep your receipts, so that way you let that nest egg just grow and grow and grow.
Mhm.
And then later in life, whenever you want, cash those receipts back in from it. Because if you go on Medicare, you can only go like contribute till 65 or whatever.
Mhm.
So if you really want it to grow, let it grow and pay for
Mhm.
expenses out of pocket.
Perfect. You are teaching my presentation because that's coming up in a
Oh.
moment. You're perfectly fine. I'm glad you're saying that. And yeah, just could we all hear that on Zoom? Do I need to repeat what he was saying? I'll assume that they heard it, and if they want me to repeat it, I'll repeat it.
I do have another question too.
Do you have a question?
Yeah.
Okay.
Is it possible with WEX to have your monthly contribution go into an investment account if your cash balance is $1,000, or do I need to manually move it over periodically?
So the question is if you can have your funds go into investments automatically if you're below $1,000. I think I used Wex's 1,000 as my example here, so I think that's the case. But the answer would be Wex isn't going to allow you to contribute to your investment accounts if your cash is below 1,000, as far as I know. I think that's kind of a limitation. They're not going to let you go below that. So
It sounds like everyone heard the
they did.
discussion. Yeah.
Perfect. Awesome. Okay. So let's jump into distribution strategies. And I will say where I mentioned some contribution strategies that some were kind of less optimal or maybe beginner approach. With the distribution strategies, I don't think any of them are terrible strategies. It really depends on how you do your finances. But I do want to propose some strategies that maybe get you thinking a little bit differently about how or when you decide to withdraw your funds from your HSA. So we'll start with regular reimbursements. I think a lot of people, when they jump into an HSA, this is kind of the plan is, as I have medical expenses, I'm going to reimburse myself for those. And I put a few different personality types maybe with that. You might have someone who they don't want to spend more on medical than they have to, and they want to have more fun money or whatever. So that's the spender. And really, that's what an HSA is there for. You're taking advantage of all the tax benefits for those funds for that, that you had. The saver might reimburse themselves, but then just save that money somewhere else. And then the budgeter might withdraw. They keep their contribution steady so that from month to month they can level out their medical expense on their budget. And then as they have a doctor's bill, they reimburse themselves, and that keeps, again, their budget stays with that, whatever they're contributing to their health accounts. So I wanted to put the number 3 way to grow your HSA. The number 3 way is to never have medical expenses. And I put that with a winky face because really we can't not have medical expenses. You can do things to control them and decrease them, and that's one of the great things about a high deductible health plan is you're more conscientious about some of those things you can do. But really, we're all going to have medical expenses. So, but kind of on it, going back to what you had mentioned, we don't, just because we have medical expenses doesn't mean we need to take those out of the HSA. So we can actually grow our HSA, leaving funds there that we could have or can pull out, but we choose to leave it there and have it grow. And that's this first one. The HSA grower is the title I put with it. But you're going to save all your documentation so that when you decide to pull it out, you can. And what this does is, again, especially if you're investing it, all that growth that occurs, you're not getting taxed as it grows. And it's building up a retirement account for you, and one that potentially has those benefits of withdrawing for medical purposes without tax. So this is a great strategy if you can afford to not, if you don't need to reimburse yourself. That's a great strategy. I wanted to point out this third bullet point under HSA grower is one advantage of this is you can kind of make your HSA double as an emergency fund because any expenses you have documented from the past that are eligible, you could use those. If, say, your car breaks down and you need to repair your car, you can say, I'm going to reimburse for the medical, and then you take those funds and you pay the bill to fix your car. So that's something you can do. Yeah, question.
Medical expenses for like decades and then reimbursed it later.
I know, isn't that crazy? You don't have to reimburse. There's no deadline to reimburse. So kind of crazy.
I have a question. Is there a statute of limitations on submitting expenses to the HSA later?
The question is statute of limitations. My understanding of statute of limitations is a deadline. I don't know if there's more to the question than that, but no, there's no deadline for submitting. No deadline for submitting to the HSA account. In fact, to be honest, you don't even actually have to send anything to the HSA account. And this is just a personal thing that I actually don't submit any of my documentation to them, because I just put it with my tax records. Where I keep my electronic tax files, I have a folder for HSA, and that's where I put all my documentation. So, yeah.
Next question.
All right. Okay. The next, so HSA grower is something I've heard a few times, and it's a great strategy. But I do want to introduce something that maybe is worth considering beyond what you'll often hear, or what some people I've heard say. And this is what I'm going to call the double dipper. And the way this works is, if you aren't maxing out all your tax advantaged accounts, you can withdraw your qualified medical expenses. And then, because you don't need those for day-to-day living, you can actually use those to increase your contributions to another retirement account. And the nice thing is, you can do it in your HSA and take advantage of the FICA tax savings again. You can do it in a traditional, which doesn't give you the FICA savings, but if you've maxed out your HSA and you want to go traditional, you can do that, and that'll save you taxes in the current year. Sorry, I should go through the slides because I have some of the pros and cons. So if you double dip using the HSA, you get to deduct taxes a second time for the current year, and possibly including FICA if you're doing it through paycheck. The con is, if you later decide you have that emergency of the car that broke down, now you can't take that out because you've already reimbursed yourself for your medical expenses. So just something to be aware of as you're considering this option. For a pre-tax account or a traditional retirement account, you still get to deduct taxes a second time. And then the cons are the same, with the added con that you don't get to withdraw from the traditional for medical. So if you have a lot more expenses in retirement, medical expenses, than you realize, you may end up with medical expenses that you don't get to take advantage of that tax break. Yeah.
But if I'm maxing out my contribution each year, then I can't deduct a second time. So I mean, I put in the full amount, right? I can't put in the full 7,300, pay myself back for prior purchases, and then invest, put more in, deduct more, correct? I mean,
yeah. So you are limited to whatever your total for the year is. But that's where, again, so the first one was contribute to an HSA, but you can actually double dip if you're not maxing out your other retirement accounts, an IRA or your 403b, for example. That's where you can take advantage of some of those tax advantages by contributing to your traditional account or your Roth account. Does that make sense?
no, how can I avoid the FICA twice?
Okay, so with HSA, it's only with HSA you can avoid the FICA twice, only if you can contribute. But if you have maxed it out, then you wouldn't be able to do the double dipping in an HSA at all if you've maxed it out. Okay. But what I do want to, so you're right, there is that limitation, and that's where you might consider, well, maybe I'm not maxing out my traditional or my Roth, And so you say, and so you, instead of putting it in an HSA, you put it in the traditional. But again, if you do that, you can't use it for medical. So you lose a little bit of that, but hopefully if you're maxing out your HSA, that shouldn't be a concern. You should have enough in retirement, but something to be aware of. Any other questions? Okay, and then one more for the Roth. I'm gonna state it out loud. I have a bias towards Roths, and I know it's not right for everyone, and some people have a bias entirely the other way. And I appreciate that there are differences, but I want to state that that's a bias. So as I say this, just know that it's a biased statement. But what I like about the option of double dipping in a Roth is essentially I think of it as I've already gotten the tax advantage when I put it into the HSA. But now if I put it into a Roth, when it gets to withdrawal time, I don't have to worry about whatever I want to spend it on. I can buy a new car, I can buy whatever, and there's no taxes. Again, it's just understanding how Roths work, how traditional like retirement accounts work, and just figuring out what advantage do you want to have? Do you want to double dip in saving taxes today? Or do you want to move your funds so they can grow and you don't have to limit it to medical expenses to get the tax advantage? So there's that. Any questions? Okay. Here are some gotchas, just things to be aware of as you're taking distributions. You might think that just because someone's on your medical plan, you can pay for their expenses and then reimburse it through the HSA. HSA distributions are very closely tied to your tax return for that year. And so you would need to make sure that if you're paying for a child's medical expenses and say they're married, you can't you can pay for them, you can be nice and pay for it, but you can't use your HSA funds to reimburse yourself for that if it's for someone who does not qualify as a spouse on your tax form or dependent. And if there's any questions on that, I don't know that I can get too much into the details on that. That's just kind of something to watch out for. And then another gotcha, I was actually, as I was preparing this, I was hoping that by reimbursing myself regularly, that I could avoid needing to keep documentation for forever. But the few websites I found that made it sound like you probably should hold on to it even beyond the 3 years that the IRS can audit you, as long as essentially hold on to the receipts until that HSA account gets closed, which I expect my HSA to last me till after I die. So that means keep the documentation, put it in the electronic folder and keep it. So. All right. Before I do a review, any questions? Because this is pretty close. This is pretty much the end of what I have prepared. Yeah.
I would just let people know it's really easy to use, especially if they give you the debit card. And you swipe it, pay for it. It does everything automatically, and it's really easy to use.
Yeah, that's really good to know. And to point out that, yeah, it's HSAs can be intimidating, especially if you're coming from an FSA, because there's a lot of steps you have to go through to do an FSA. HSA, the burden's on you to keep the documentation, but really how you do that and where you do it is up to you. And it's really not complicated to use HSA funds. So especially if you've got the debit card. One thing I think I skipped it. I think it's a skipped slide. So if you have the QR code and you look at the slides, one thing I did skip over is with WEX and probably other banks, you can use the debit card to pay as you go, like swipe it at the pharmacy or whatever. You can send money from the website directly to a provider. You just put their contact information and it'll mail a check to them. Something I heard a coworker had done is they actually scheduled payments. So if you set up a payment plan with the hospital or a medical provider, you can set them up as a provider and then schedule that payment plan so that the money goes, as contributions go into your HSA, it can send those right over to the doctor. So Or just what I do is I just pay for things with however I pay for things, debit card, credit card, whatever, and then I'll reimburse myself. Because I'm at the stage where I do have a budget and I try to max out what I can with my budget, all the other things. So even though double dipping is what I'd love to say I do, just the way I budget, I'd like to have that consistency in the medical. And I don't have to pull funds from somewhere else to cover those medical expenses.
And a couple things online. Just real quick.
Yeah,
Lisa just wanted to chime in. She said, one thing I noticed that medical providers will offer a cash discount if you pay upfront for procedures and use your HSA funds for that, which can definitely help reduce the medical costs. It still runs through the insurance, but you pay you pay out of pocket. I would always ask the provider if they offer a cash discount.
yeah, that's a great point. And you can do that even with the white and blue or with a traditional plan, but where the benefit comes in with the high deductible is if you get a 5% discount at a doctor's office and it's on a $3,000 bill, 5% of 3,000 is a lot more than 5% of say it costs 1,000 from the other plans. So something to think about. And yeah, great point. And I have done that. You can ask up front. I've even asked after the fact. And like I know the hospital will do this. If you ask, hey, if I pay the bill in full, can I get a discount? And I think their policy is something like once a year you can take advantage of that. So when we've had babies, for example, and we get all the bills, I'll say, hey, can I get a discount? And it saves a few $100s, which can help. So
And then, do you need to go through a financial advisor to set up an HSA?
you do not need to go through a financial advisor. And if you're uncomfortable doing it by yourself, you are welcome to meet with a financial advisor. Again, you might not think you have one, or you might think you have to pay for one, but as I put on earlier slides, at Utah State and with a lot of retirement plans, you can get access to a financial advisor, and they don't necessarily limit their conversation to them and retirement. They can expand that or go beyond that. So great question. Is that it online? Perfect. Okay. More questions. You can send more questions as we go, but I'm going to quickly do a kind of a recap. And here's what my recommendations would be, recapping what we've discussed today. So for contributions to grow your HSA, I would recommend, now that you've had this, hopefully a new idea, or maybe you've heard of it before, but you know that your HSA can follow you into retirement, maybe think a little bit differently of it and see if you can't contribute more to your HSA, realizing that this will pay for medical expenses in retirement. And if you're in a 22% tax bracket, paying for your medical bills with your traditional retirement accounts, you're paying taxes 22% for, if you have $1,000, that's $220 something that you're paying in taxes because you had to withdraw to pay for your medical. Whereas if you do the HSA and you build that up, you can withdraw that in retirement, no tax. So consider contributing more to your HSA than you're going to need in the next couple of years. Okay, that's, I guess, the takeaway from that. And maybe even consider maxing out HSAs as part of your retirement, as part of funding your retirement. Just also make sure that you know that you're contributing for medical, because medical expenses are going to happen and you don't want to deplete retirement because of medical, if you can avoid that. All right, for growth, invest. And this is something it took me years to get to investing. So that's why I bring it up. It's a simple thing. I can't really tell you where to invest. And I think more important than where to invest is that you just start. Make some mistakes, figure out what you like, what you don't like as far as where you invest it, but start investing. And then also for growth, know that you can expand your options if you feel limited with whatever HSA provider you have. You can move funds around. You're not limited. You're not tied to whatever plan your funds are currently in, even while employed. Because that was something that I thought found it helpful, I guess, at one point in time. So distributions, again, if you don't need to reimburse yourself to financially cover medical emergencies or medical occurrences, maybe leave the funds in the HSA to build that great tax savings vehicle, or consider double dipping if you're not maximizing your contributions to your retirement accounts. And if you regularly reimburse yourself like I do, just review your budget to make sure that that you are contributing what you can to your HSA and retirement accounts to take advantage of those tax advantages that you get with those accounts. So, thank you so much. If there's any additional questions, I'll address those. But I have appreciated having questions throughout. I feel like it helps to address them in context.